Good morning, everyone. We're going to jump right into it today. Stock futures were slightly lower early Friday, as traders poured through major bank earnings. The S&P 500 futures edged 0.2% higher. It's a little goodness this morning. While Dow Jones Industrial Average futures gained 0.3%, NASDAQ 100 futures added less than 0.1%. JP Morgan Chase and Wells Fargo kicked off third quarter earnings for major financial firms on Friday. Shares of JP Morgan Chase gained 1.1% after the company topped profit in revenue expectations. Wells Fargo rose 2.2% in the pre-market after surpassing Wall Street's earnings and revenue expectations. Shares of Citigroup jumped 3% after posting higher than expected revenue, fueled by solid growth in both the institutional clients and personal banking. As major bank stocks rose, U.S. Treasury yields declined. The yield on the 10-year Treasury, well, we'll get to that in a moment. I have an article actually coming up on the Treasury yields here. It says, besides fears over earnings guidance, my apologies, over earnings guidance and another potential rate hike, which I do think is coming, investors have also turned their concerns to the ongoing geopolitical tension, which could potentially threaten global oil supply and prices. I actually had an article here on oil. And listen, yeah, oil went up. There were some more sanctions that occurred. Okay. So more sanctions were issued against certain entities, you know who. And so oil did go up $3. All right. Oil went up $3. However, they're saying that, long term is going to be inconsequential. This is what they're saying. Now, I'm not concerned with the amount that it went up because of the new sanctions. That's not what I think most people are going to focus on. What they're going to focus on are the overall effects of OPEC plus cuts long term. So what we've seen so far, and obviously it affects everything. But what we've seen so far is just short term things occurring, right? Which already there was ripple effect was felt short term. Now, once again, I'm waiting on clarification as to why there was this increase in storage of oil, right? Which they allege brought down a lot of the pressure on the oil markets. How long? And that's what I need clarified. How long can that be sustained? Because obviously that's going to affect the price at the pump. That's going to affect food prices long term. I mean, so all of those numbers have to be crunched, and then we have to get our hands on that data. That's what I'm looking at, even though, of course, the $3 increase on oil is what's making all the headlines. That's hot news right now, right? It says, quote, we'll have some companies that will disappoint, but I think for the most part, earnings are probably going to surprise investors to the upside, unquote. She said in an interview with CNBC, quote, investors are too pessimistic. We expect that companies are going to be able to manage this pretty well. Tangler added she thinks stocks will end the year with a rally. There's a lot of factors that you got, a lot of variables you got to take into account there, don't you? It says, led by the technology and industrials sectors. Traders are also watching for preliminary consumer sentiment data for October out on Friday. All three major indexes ended the Thursday session in the red. We covered that yesterday's video, with the Dow dropping more than 173 points. The S&P 500 slid 0.6% along with the tech-heavy NASDAQ composite. The major averages also snapped 4-day winning streaks, even though the three major averages ended Thursday with losses. They are each on pace for weekly gains. So VIX updates, volatility index news. So right now the VIX is at 16.88 plus 0.19. Let's scroll down here. So previous close was 16.69. Opening 16.53, days range 16.50 to 1773. So listen, we're going to keep an eye on the VIX, but let's move on here to Treasury yields. And this article here comes from marketwatch.com. All eyes on Treasuries as it affects everything, obviously, right? It says, long-term Treasury yields are likely to fall by the end of the year. Likely doesn't mean it's a guarantee. Likely to fall by the end of the year, but it may not keep stocks and corporate bonds rising, according to Capital Economics. The 10-year BX and the 30-year BX Treasury rates have pulled back, respectively, from their 16-year high reached last week. Information is all over the place here. It says, despite a rebound on Thursday, I mean, this just Treasury markets are all types of crazy right now. The 10-year Treasury yield rose 9 basis points on Thursday to around 4.65, that we know. And the 30-year Treasury rate gained 8.7 basis points to 4.785%. Now, listen, a lot of what I've been reading is that a lot of experts think it's going to go higher. And given that there's constantly sell-offs happening and they want to draw people back in, I don't see why it would not go higher, especially if they're going to keep interest rates higher for longer. It says the retreat of Treasury rates helped support the gains of U.S. equities and corporate bonds earlier this week, as the 3 stock indexes recorded 4 consecutive winning days of trading. The ICE B of A U.S. corporate index's yield fell 5 basis points to 6.08% on Wednesday, according to the Federal Reserve economic data. Bond prices and yields move in opposite direction. Says, but the situation is unlikely to hold. Hubert de Barraquez, market economist at Capital Economics, wrote in a recent note. While Treasury yields may continue to fall, quote, we think that Treasury's relationship with corporate bonds and equities will break down in the near term before reasserting itself next year, unquote, de Barraquez said. Says here, for corporate bonds, a further decline in risk-free rates could be offset by widening spreads as economic conditions deteriorate, according to de Barraquez. Credit spreads refer to the compensation investors can earn on corporate bonds versus the risk-free U.S. Treasury rate. The gauge tends to widen in jittery markets when economic growth looks likely to slow, which can make investors more wary about not getting paid back in full if corporate defaults climb. Let me read that again. Let me read that one more time. The gauge tends to widen in jittery markets. I'd say there's a lot of jitters. Or when economic growth looks likely to slow. I mean, listen, I'm hearing about all types of layoffs going on. All types of businesses are closing. Lending is tighter. So, I mean, that's going to bring a lot more problems to small businesses, obviously. I mean, business of all size, but mostly medium to small size businesses, correct, if lending is tighter. I mean, there's so much. People can't afford homes. Listen, I just, not only that, let me add this. That the people ran out of money, according to the data. The people are running out of money about a month ago, right? The checkings accounts and savings accounts are at all-time lows, and then they were riding off of credit for a long time. This is what the articles say, the pros say, and now it's showing that most of these individuals have maxed out their credit cards. How does the economy not rapidly, this is where we get into true deceleration, by the way, right? Deceleration. So, I mean, I just don't understand how it's not going to do something like this. Everything points in that direction. So let's continue to read that little piece just once again. It says, or when economic growth looks likely to slow, which can make investors more wary, they should be, about not getting paid back in full if corporate defaults climb. I'm just going to let that marinate for a minute when you're reading the rest of the news for the day, right? Okay. We're going to close out here, folks, with a little bit of Brics Nation news. Of course, we know that Brics is influencing gold, gold collection, etc. It says this from Watcher.Guru. Brics influence global acquisition of gold to ditch U.S. dollar reserves. It says here the Brics Economic Alliance has undoubtedly influenced a global acquisition of gold as a host of countries seek to ditch their U.S. dollar reserve. Not only that, but a lot of people who like to feast on gold, they love the gold, baby. They know that all of that activity could cause gold to skyrocket. Not just that activity, right? Which has built a little bit of a cushion for the price of gold. You want to be realistic about it. If you saw where gold was like last year and a half ago. But that in combination with the possible collapsing of many banks in the West, because their banks are in trouble, the people will flock to gold, right? This is what happened before. I think it will happen again. And that could cause the price to skyrocket as well. So all of this plays together for a beautiful future, in my humble opinion. Not financial advice, I'm not a financial advisor, but a beautiful future for gold. I'll also throw silver in there, but silver to a lesser degree. But here, let's continue on with this. It says, indeed, the economic bloc has set out on a de-dollarization plan in order to further promote local currency subsequently. Central banks have been purchasing gold at record rates. I keep telling people this. There's something coming. There's a reason that they are doing this and never did this before. And it's not just Brics nations either. Let's keep going here. It says, according to a new report from Markets Insider, a variety of central banks are seeking to reduce and, quote, over concentration, unquote, of U.S. dollar reserves. Another thing that they're doing, if you saw the article that came out about Zimbabwe, which is very interesting, that a lot of crypto companies are getting deep in areas where they're going to be tokenizing gold, or they already have gold tokenized, but they're trying to push it on the people and take advantage of that moment where possibly there is a flood of transactions in gold-backed digital currencies flowing across their blockchains. But let me move on from there. But if you look at what happened in Zimbabwe, they have that digital currency backed by gold, and now they're pushing that. So listen, that also, like, you're not moving the physical gold, but you're moving the value of it. So that brings a lot of worth to gold itself outright. That also adds to everything, But and they're doing that. Sorry, but let me circle around. They're doing that to lure their people away from this desire that they have for dollars, right? So it all glues together. Says, therefore, these countries have opted to purchase record amounts of the metal. The move aligns with overall Brics activity throughout the year and the poor performance of the greenback. There's so much going on with the dollar. It's unbelievable. But people don't want to believe that the dollar is in jeopardy. I would never say the dollar's going to zero. I wouldn't say that at all. No. But it's already being greatly injured by its own government. Factual. Just look at the historical charts. Right. So the value, listen, this is why everybody's looking for everything but the dollar in order to preserve their value. Now, wait a minute. Now, I know what you're going to say. I know you saw the articles. There are a lot of individuals who are pulling capital and keeping cash on the side right now. Ton of articles out the last 3 days about that. All right. All the big money is pulling some money out, keeping cash on the side. The question is, why? Why are they keeping cash on the side? What is coming that they're keeping cash on the side for? Now, I have my theories, but that will take another video. So now that you have that information, everyone, what are you going to do with it? I know what I'm going to do with it. So until next time, folks, let's get to the money.